today, Mike's going to talk us through what was in the CARES Act with respect to pensions and what sponsors should be thinking about as they evaluate the options in the CARES Act. So, Mike, don't walk us through all 880 pages, but tell us what was in the CARES Act about pensions.
Good news or bad news for the pension world, depending on the way you look at it, but 880 pages of caring. Pension's got 2 paragraphs, so we can break down those 2 paragraphs here. 2 parts to the pension relief. 1, a delay in required contributions. So any contributions that were previously due during calendar 2020, the due date for that has been postponed to January 1st, 2021. So Congress recognizing that plan sponsors may have a little bit of difficulty funding those contributions or have other uses for those assets. Important to note, though, that's not free relief. Pension plan sponsors will be required to pay interest on those required contributions. Interest will accrue between the original due date and the date that contribution is actually made. And when looking at the interest rate on that delayed contribution, it's going to be plan specific, but by our estimates, it looks like it's going to be in the 5 to 5.5% range in terms of interest charges.
Wow.
And then the second benefit that Congress has given to pension plan sponsors is around benefit restrictions.
Remind everybody what benefit restriction rules exist today.
Benefit restrictions are based on the plan's funded status. It's entirely plan specific, and it's based on the required contribution funded status. So if a plan falls below 80% funded on that measure, participants can't take their full benefit as a lump sum. If a plan falls below 60% on that measure, participants can't take their benefit as a lump sum at all.
Can you help us understand the difference between a calendar year, a plan year, and a off calendar year plan year, and what the advantages to the CARES Act legislation might be?
Yeah, absolutely. So the relief applies to all plans, regardless of when the plan year starts. But in practice, the benefit of the relief very different based on when the plan year starts. So for example, a calendar year plan year beginning on January 1st, ending on December 31st, there's not a whole lot of benefit to this relief. Because it's very likely that your plan's funded status was higher January 1st, 2020 than it was January 1st, 2019. But if you're an intra-year plan year, so for example, a plan year that starts on April 1st, it's a pretty big benefit from this relief. So Congress will allow plan sponsors to take the 2019 funded status for those plans in lieu of the 2020 funded status. So instead of having to take that funded status measurement April 1st, 2020, after this market turmoil, you get to look back to April 1st, 2019 to determine the plan's funded status.
What should sponsors be thinking about right now as they assess this relief? I mean, just because you're given the relief doesn't mean you have to take it, correct?
Absolutely. You are more than welcome to continue making your required contributions on time, as previously scheduled. Important things to consider on the contribution side. This isn't contribution forgiveness or contribution removal. It's simply a delay. So thinking about typical due dates for pension plan contributions, you're talking about a 3, 6, 9-month delay. For plan sponsors that are in facing some hardship and have some other outlays that they need to make, that can certainly be beneficial. But our guidance would be, continue to make those required contributions if you can. You can save a little bit on interest and not have to pay yourself back in the future.
There's a lot probably that still could be done for pensions. What were some obvious things that were missing, and what things do you think we'll be seeing in the coming stimulus packages?
Absolutely. So in terms of what's missing, if you ask pension plan sponsors, they'd probably say quite a lot. One, on the contribution side, there's certainly more room for relief. As we mentioned, this is just a delay in the due date of required contributions. Other levers that Congress could pull would be potentially forgiving required contributions for a short-term period of time, or adjusting the way required contributions are calculated. The most popular way Congress would do that would be by tweaking the calculation methodology for the discount rate when calculating those liabilities. And potentially the biggest way that Congress could move the needle in terms of pension relief is dealing with PBGC premiums. So PBGC premiums continue to be the biggest administrative expense for most pension plan sponsors. For example, in 2020, pensions are required to pay 4.5% of their deficit as an insurance premium to the PBGC. So potential ideas that we've heard floating around are potentially freezing PBGC premiums for 2020. So either keeping them at the same level as 2019 or forgiving them for 2020 in total. Another lever that Congress could pull would be lowering the maximum on those PBGC premiums. Historically, those premiums have had a cap based on a plan's participant count. Congress could bring down that cap and give some plan sponsors a little bit of relief on the insurance premium side.